Okay. I think it's about time we start. All right. Welcome everyone to this webinar on the 2020 year in review of the EDHECInfra Indices with a frightening question. Was it a bad year or the worst year for infrastructure investors? Joining me as usual in this webinar is my colleague Abhishek Gupta, and I'm Frederick Blomberg. I'm the founder of EDHECInfra and also director of EDHECInfra. And I just wanted to, for those of you who may not know us, say a few words about who we are before we get going. So EDHECInfra is originally an academic project, an academic research group. It still is a research center at EDHEC Business School. For a bit more than a year now, it's also an index provider, provider of analytics and also valuation data to a number of investors who are interested in infrastructure, asset owners, asset managers, and it's also data that regulators are looking at more and more closely. Just a couple of words of housekeeping, the usual thing. We will try and talk for 30 minutes maximum and leave some time for questions. There'll be a poll as well with some exciting questions today. And of course, if you want to ask questions, please use the Q&A function in Zoom. We will not kind of let people take over the microphone, but we will aim to answer all your questions at the end. And this webinar is recorded. Okay, so today, our agenda first is going to be in a minute, my colleague Abhishek will take over and show you the key results for Q4, for our latest index release, and also for the whole 2020. And of course, it will all be about COVID-19. In fact, in a second part, he's going to dive even deeper into this topic and show you the impact of different moments in the last year in the COVID-19 crisis in terms of valuations, their impact on cash flows, but also the impacts on risk premia, the reaction of interest rates, etc., and how market valuations have evolved over that period. After that, I will come back. I will give you a quick brief on our universe coverage, partly because people always have questions about this, but also because it's changing. So it will be interesting to show you how our tracking of the infrastructure universe is evolving and follows new types of infrastructure, or rather the infrastructure of the future. It's not really new. And I will say a few words also about our approach so you can understand better some of the results. And to conclude, I'll show you how this approach works in terms of valuation. So I'll show you some metrics in terms of how the valuation models that we use actually track market prices. So without going too much into more details, I will let Abhishek take over and show you the results for Q4. Over to you, Abhishek.
Thank you, Frederick. Hello, everyone. Right. So this release basically provides the first look at the performance of unlisted equity and private debt after we have been through a year of COVID-19. And then this becomes basically a natural question to ask. How was 2020 year for the infrastructure business? Intuitively, the answer should be pretty bad, right? But there's more to it, as we will see in the following results. So first off, this is our flagship Infra 300 index, which tracks a global sample of unlisted infrastructure equity investments worth approximately $180 billion. The index had a positive quarter with about 3% return in local currency. And for the year 2020 as a whole, the Infra 300 index finished down by 4.7%. So quite a drastic drop in just 1 year. In fact, I'll show you later, this was one of the largest drops since GFC on an year-to-year basis. So a very significant thing for the infrastructure market. On a longer horizon of 5 or 10 years, the risk-adjusted return still looks very attractive with a Sharpe ratio of 0.6. Actually, it's a bit greater than 0.6. And the value at risk for the index remains a bit less than 20% for almost all horizons. And finally, note that all these results are available in our online platform now, which is free to sign up and gives you the access to Infra 300 index. Next, we have a summary of the granular results in some specific TICCS segments. The highlighted column here indicates the 1-year total return or the return of each of these indices in 2020. We can see that the impact of COVID-19 hasn't been the same in all these TICCS segments. In fact, depending on the business or the industry or the governance structure, the return is quite different throughout the year. Let's look at merchant companies, which were more severely hit during this period, and they have a minus 6.6% return for the year. Contracted businesses in comparison are typically safer because of their stable cash flows in general, and they finished this difficult year with a decent return of a little more than 2%. Merchant roads have done fairly well, particularly in the last 2 quarters of the year. The largest contributor of negative return in merchant companies were airports, in fact, which have been terribly hit by this crisis, and some of them also face fears of insolvency now. Throughout this presentation, we'll compare these two sections and drill down deeper, highlighting the causes of the large negative return in airports and why we didn't see the similar impact in road companies. And finally, an interesting comparison in the performance of projects, which are basically the special purpose vehicles and corporate companies. The EDHECinfra Project Finance SPV Index, which tracks more than 400 live project companies. So it's a very rich index, and it is up 2.1% in 2020, with a very solid 3.6% return in just one quarter, that is Q4 2020. On a 5-year basis, the projects are still showing strong total returns of 10.3% with almost 9% vol. This is in sharp contrast, this performance of projects is in sharp contrast with corporates, which despite having a positive return in the last quarter of 1.32%, on an year-to-year basis, this index returned minus 13.5%. So they were very significantly hit by this crisis. Finally, I wanted to point out that all these TICCS segments or these sub-indices are visible in our platform, and they can be filtered nicely, and the entire historical information is available to see in the online platform. Next, we look at the decomposition of the total return into its two components, that is the change in capital value and the cash yield of the companies. On the first look at the return contribution, here we can see that the drawdowns in the price return are of the same magnitude that were last seen during the financial crisis of 2008. So it has been a very significant impact or year for infrastructure businesses. But on the positive side, the high and stable cash yield remained a distinctive feature of infrastructure as a whole. And even though some companies such as airports are expected to be in lockups this year and may not pay any dividends at all in 2020, but the average cash yield still remained in the 7 to 8% range. Next, we want to look at the impact of FX, that is on different currency indices. The currency risk is quite significant for investors, and we are constantly asked about the performance in different currencies. While Infra 300 is a global index, here we can see in the allocation that the exposure to euro and pounds is quite significant, in total at about 65%. So, of course, the impact of how different currencies are moving will lead to different return levels for the index. So when looking at the performance in other currencies besides local, and I wanted to point out the 1-year return here in particular. The USD return is almost 6% higher. It's actually positive for the year and 6% higher than the local currency return. Whereas the return in pound is also less negative than the local return, and the index has done much worse in euro in total, which has a minus 7% return for the year. But to point out that there is a diversification in time effect going on here. So if you look at the longer horizons of 10-year or since inception, the return differentials between different currencies are rather smaller. So over time, they get diversified how the currencies move. Now looking at the debt side, the broad market index has ended 2020 strongly at 6.15% return for the year. It has not been the same impact from COVID. It has not seen the same impact from COVID as the equity counterpart. And most likely it's also due to the lower interest rates that we have seen, and also the credit spreads have returned back to their pre-COVID levels. The return in the longer horizons of 5-year and 10-year also remain quite strong, with a very attractive Sharpe ratio for the index. Now, considering the credit spreads, I mentioned that the spreads have returned to their pre-COVID-19 levels, but let's look at the average yield to maturity, which has still shrunk quite a lot. And that's due to the differential of interest rates, which have actually led to a negative real yield in many countries now. So that was the high-level result overall. And we noted that clearly COVID-19 has had an extraordinary impact on this asset class. Now, in this section, I'll explain how we measure this impact in different infrastructure companies by considering the effect of the 3 discounted cash flow components, that is, the future cash flows, the risk premia, and the interest rates. So first component of any DCF model is the future cash flows. And we have a team of analysts who make an assessment of each sector based on the latest reported accounts, market activity, etc. They publish a detailed sector report with the estimates and any other assumptions which are involved. And all these reports are available on our website. So it's publicly available and transparent. Throughout 2020, they worked really hard to update these views as new information constantly arrived. For example, the road traffic estimates changed, or the air traffic data was updated, and we captured all this information to update our views on the future cash flows. In 2020, the largest drop we noted was in the future revenues of some merchant transport companies, particularly in airports, followed by some other large corporates such as utility and power generation companies. Next, we consider the impact to risk premia of the infrastructure companies. We have developed a multi-factor pricing model, which basically combines fundamental information of companies, such as how much leverage do they have, what is the size, profitability, along with some other macroeconomic factors, such as the term spread of interest rates and so on. The idea is to estimate the risk premium in all the companies in our universe. And this model is calibrated using the secondary market prices. So it picks up the effect of COVID-19 quite efficiently based on the market activity. We have also made adjustments to the profitability estimates of these companies as they suffered through the crisis. We will show this in more detail in the following slides. But largely the lower profitability in 2020 has also allowed us to capture the higher risk premia throughout the year. Third aspect of discounted cash flow is, of course, interest rates. And for this, we use the full term structure of interest rates in respective countries, which is extrapolated from the government bond yields. And we have seen that interest rates were more or less lowered in almost all the countries across the world. In this chart, we note the higher risk premium in Q1 and Q2 2020, and correspondingly the discount rates or the required expected return have settled around 8% range, which was last seen in the 2018 period. But I would like to point out here that the discount rates were higher in 2018 due to the interest rates being higher, but now they are higher due to the increased risk premia since the rates are close to zero. So it implies that the price of risk actually has increased because of this crisis. These differences over this year are also visible in this table below, where we show the risk premia in equity and credit spread in the case of debt. Equity risk premia has increased by 140 to 150 basis points in the year, and spreads actually have reduced a bit in the corporate debt and have stayed almost the same for project debt. Now, with this understanding, we can decompose the effect of each of these DCF components and understand what happens to the valuation. We had shown you this analysis in our webinars last year, and since then it has become a standard for us to review the quarterly results in this fashion. So here we take the 3 components of DCF and isolate their effect by changing one of them at a time and see how it changes the NAV of each company and then take the average across different companies. So basically, we are trying to understand what is the quarter-on-quarter change in the NAVs by changing one DCF component at a time. And this allows us to build a picture like this. So in this table, we show you these effects for the 4 quarters of 2020. And the first column shows basically the change in NAV from Q3 2020 to Q4 2020, which is split by different DCF components. The second column shows you the change from Q2 to Q3 and so on, going back in time for the 4 quarters. In the final row of the table, we show you the aggregate change in valuations by changing all the 3 DCF components at the same time. And do note that these effects are not linearly additive because of the DCF equation itself. We see that the aggregate impact on NAV in the first 2 quarters was negative, but the Q3 and Q4 performance has been slightly positive, especially in Q4. That means that while on aggregate valuations were lower in 2020, there were still upsides in 2 quarters throughout the year. Then looking at the dividend forecast, it was particularly lowered in the first 2 quarters as COVID-19 broke out and lockdowns were enforced. This lowered the valuations by more than 5% in total in the first 2 quarters. Then in the second half of the year, some of the dividend forecasts, like in road companies, were revised upward as more traffic data became available, and it led the positive valuation in the respective quarters. Looking at interest rates, they have been reduced in all 4 quarters, causing an impact of more than 5% on the valuation. So they have provided some upside to the valuation in effect. Finally, we look at the risk premia, which increased sharply in Q1 2020, followed by a modest increase in the next 2 quarters. And in Q4, it has actually reduced by 10 basis points on average. Change in risk premia has a much bigger impact on the valuations as compared to the change in cash flows. And this I would like to point out with the example of Q1, for instance. The change in cash flows caused a drop of minus 1.58% in the valuation, whereas just the jump in risk premia caused a 4 times bigger impact on the valuation. So it is much more sensitive to the risk premia. So it's not just enough to estimate the reduced cash flows or the hit on the cash flows, but also to understand how the risk in the companies have evolved because of any crisis. And our calculation methodology basically allows us to see these effects and their magnitudes quite clearly. Continuing this analysis for a granular segment, we compare merchant roads here over the 4 quarters of 2020. They've basically negated most of the early impact of COVID-19 and finished the year with higher valuations, in fact, in total. The drop in their revenues was smaller as compared to other companies and was mostly limited to Q1 and Q2 2020. These effects were partially offset by the larger decreases in interest rates in some countries, particularly in Q2, where the interest rates on average dropped by 43 basis points. Their future cash flows improved in the second half of the year, and it led a large increase in the valuations of about 15% in total. And that has been the recovery mode for these merchant roads. The risk premium in these companies has increased by 120 basis points throughout the year, indicating the increased risk in the underlying valuation of these companies. We contrast the example of merchant roads now with airports. Airports have had a much worse year, and their valuations were lowered in all the 4 quarters throughout the year. And we saw that aggregate performance in 2020 was minus 35%. So it's a very significant impact. Firstly, their future cash flows were lowered by about 3.5% on average, which resulted in a valuation drop of about 10% in aggregate. So that was the first big impact that we saw in the valuation of the airport companies. But the largest impact came in the first half of the year, and it was driven by the sharp increase in equity risk premia. It increased by more than 130 basis points in just 1 quarter alone. And throughout the year, the equity risk premia has increased by 300 basis points. So it has been a really sharp jump in the risk premia of airport companies. We also see that lower cash flows in Q1 2020 caused a minus 5% valuations. Lower interest rates in Q1 2020, for example, caused a minus 5% change in valuations, where the jump in risk premia alone had a 3 times larger impact. So the cash flows lowered the valuation by -5% here, and the risk premium increase of 137 basis points dropped the valuation by 17%. So again, stressing on the point that the change in risk premium is much more important than the change in cash flows. Now going back into the contracted versus merchant comparison, and now we look at the expected returns in these two groups. Discount rates or the expected returns, they are the combination of equity risk premium and interest rates. And they've increased considerably for merchant companies. They now stand at 9.34% as of Q4 2020. In comparison, we note that contracted companies have fared much well through this crisis. And while their expected return did increase in Q1, it has trended lower since. On the right-hand side chart, we see one of the most influential factors in our asset pricing model, that is the profitability of a company. It is denoted by return over assets, and it has an inverse relationship to equity risk premium. That is, higher profitability lowers the risk premium of a company. And we find that the average profitability estimates in merchant companies has dropped by almost 3% due to this pandemic. So it has gone from the level of about 12%, slightly higher than 12%, to slightly higher than 9% now. Whereas it has remained stable in contracted companies. That's again driven by their nature of business. Similarly, here we contrast the behavior of discount rates or the required expected return in merchant roads and airports. As mentioned before, the price of risk has increased significantly in airports, causing a jump of 300 basis points in their expected returns. It stands at 8% as of the last quarter, a level that is much higher than that of merchant roads. In the right side chart, we note that the estimated profitability is the driving factor behind this increase in the discount rate, as it turned negative in 2020 for airports. Profitability of merchant roads also reduced in 2020, and they lost about a quarter of it on average. Right, so now I have the summary of the results that I showed you and the key findings from these results. So first, we saw that 2020 finished with a loss for the asset class as a whole. This was the first largest loss since the GFC on a year-on-year basis. We saw a return of -4.7% in this year. And this was the last we saw a large negative return was in 9.2% return, -9.2% return in the first quarter of 2009. So it has been a very significant impact. And second, unlike GFC, COVID-19 caused an economic shock impacting the bottom line of infrastructure companies. It not only degraded the cash flows of merchant and regulated companies, but also increased equity risk premium across the board. So almost all the companies, be it merchant, contracted, at least saw some impact of COVID-19. Third, the impact of the higher risk premium on the valuations was much larger as compared to the impact of the reduced cash flows. And this point I've tried to stress again and again throughout these slides, that it is important to understand the risk in the infrastructure businesses while valuing them. Then we saw that asset class was essentially split into two clear groups. Infrastructure contracted projects performed fairly well without any losses in the year, whereas corporates suffered large write-downs. Fifth, we saw the negative returns were partially offset by the high cash yield, which remains a redeeming feature of this asset class. Sixth, we saw the expected returns or the discount rates have increased despite the lower interest rates across the board. It indicates that the price of risk has increased in the asset class. And finally, we saw that infrastructure debt has performed well and shined in 2020, even though some of the credit risk metrics such as probability of default or expected loss have increased and signal a higher risk in these debt instruments. This is it from my side. I now hand it over to Frederick to take you through to the rest of the presentation. Thank you.
Thank you, Abhishek. And let me carry on. So thank you for these results and all these insights from all the work that we did in 2020. Let me just now give you a bit of, and I saw there were already several questions on our methodology. So let me give you a little bit of background on where this data is coming from, how we computed these results. And then I'll answer one of the questions that was asked during the first part of the presentation on the precision of the valuation approach. So let's start with the universe. So how does this work? And when we say that we're tracking the market, we've developed an approach, if you want to define what the market is, which is very much rooted in IFRS 13. So the idea is to look at the principal market, which is where most trading takes place, where there are the most buyers and sellers, and to see what pricing tells us in these markets. So this principal market we've determined to be 25 countries, 25 national markets in the world. So I don't have the detailed list here, but this is available on our website. It's obviously all the usual suspects. It's North America, Europe, Australia, parts of Southeast Asia, parts of Latin America, where there has been historically more privatizations, more PPPs, and also where institutional investors have been much more active, and also fund managers have been much more active when it comes to infrastructure private deals. Okay, so we've established what is the investable population by using desk research, looking at each country, looking at its history, the investable population of companies. So, which is essentially every single SPV, every single project finance SPV, and every single so-called infrastructure corporate. So the airports, the ports, the utilities, etc., which are usually fully private, which exist. And when I say that we've identified it, it means that we know their name, we know their company registration number, and we also know what they're like, meaning we know their size, we know what sectors they're in, what TICCS segments they're in, so what business model they're in. Are they regulated? Are they merchant? Are they a power company? Are they a pipeline company, etc.? And also, are they a project or a corporate? I just said that. So we have all these elements, and based on the structure of the investable market, we can design a sample of this market, which tracks its structure over time. So the sample that we have is quite different over time, because 20 years ago, this sector was quite different. The type of companies you could invest in and the countries where they were available were different. And over time, as you can imagine, there are more and more countries that have private infrastructure, there are more PPPs, and more social infrastructure, there are many more renewable energy projects, etc. So the sample and the population evolve together. Okay, so this is how we build the data that goes into these indices. The point is that we want to avoid any kind of reporting bias or survivorship bias that you find in contributed data, which is typically what private indices are like. That's data that's contributed by various investors. Creates all sorts of issues which are very difficult to avoid in terms of selection and survivorship bias. So here we have everything, and we have when I say we have no survivorship bias, we have plenty of companies that end up going bankrupt, or end up in default, or end up being renationalized, or so all the things that can happen, which would normally kick out investments from a reported database, stay in this database. So that's the universe. This universe, incidentally, is evolving. So this year we continue to track it, and we also make I would say little tilts or little strategic choices in our selection of the data. So, for example, we've added 41 companies to the list of companies that we track in 2020, and we've made sure that we tended to track more data and renewable projects. So this is the chart on the left. You see that the percentage terms by number of companies on the data and renewable projects have tended to increase. Also social infrastructure, because there's more of that in the samples to stay representative, and some things are decreasing in weight. For example, power. You can also see in the middle that we're tracking more and more contracted in proportion, again, not in absolute value, but we tend to add more contracted assets to our universe, simply because, well, the underlying population is like that. There are more and more contracted projects. Likewise, third chart on the right, in relative terms, we tend to have more and more projects, finance SPVs, and fewer corporates. This also makes sense, because if you think about the infrastructure that's being financed, that's being developed today, or that was being developed maybe 2 or 3 years ago, it's mostly projects, new projects. It's mostly renewables and data. There are also many more airports that can be privatized, and there are some, of course, but the sort of waves of privatizations have taken place in a number of countries, and the universe is not expanding in this case. Right, so once we have this representative sample, and we've adjusted it to track the infrastructure of today and of tomorrow, we can build an index. So for example, the infrastructure 300 index that Abhishek was showing you, you can see its makeup by segments on the left of each one of these charts. So for example, if I take the one on the left, on the far left, it's the universe versus the index split by business model, what we called business risk. So contracted, merchant, or regulated. And you can see that it's not perfect, but we aim to match the universe as much as possible. This is not a perfect match ever, because there are limitations in the availability of some data. There are limitations in the fact that this is an index with 300 assets, etc. But to the extent that it's possible, we try to replicate the structure of the universe. And you can see it's pretty close when it comes to business risk, which is probably, to me, one of the most important segmentations. In the middle, you see the segmentations by what we call industrial activity or sectors. Here you see that there's a little bit more imbalance in some cases, but roughly it corresponds to the universe. And on the right-hand side, corporates versus projects. And here you can see again that we actually have a bit more projects in the infrastructure 300 than the universe. So here we acknowledge that, and this is also a feature of having 300 assets, that, because imagine in order to build this sample, you have to meet all these criteria. In order to have 300 assets that match all of these business risk, sector, and corporate structure profile, you have to make some sacrifices sometimes. So here we have a larger share of projects than there actually is in the universe. But it's roughly, it's roughly in at least, well, you can see the transparently what it's like. Okay, so this is where the data comes from and how we put it together. I just want to say one more thing about the valuation before I show you how it actually works. Normally, when you price private assets, if you think about real estate, for instance, you try and find comparable transactions, right? So you try and price a shopping mall, you're going to try and find other shopping malls, hopefully not too far, hopefully quite similar, hopefully that traded quite recently, and you have your comparators. Here it's impossible to do, right? Infrastructure companies are quite different from each other. There are many fewer than there are shopping malls. They don't trade very often. And so if we were trying to use comparisons directly, it would basically require more data than there ever were infrastructure transactions. So that's really not going to work. But the magic of statistics is that we can actually turn this problem around. So we can reduce this problem of having to find hundreds of airports or pipelines that look the same and which don't exist, to pricing a limited number of risk factors in existing private asset transactions. Okay, so this is real market data, which we're going to decompose by risk factor, and then we're going to use these risk factors and their prices, the risk premium effectively, to price assets that are not being traded, that are not being bought or sold. And so as a result, we can price all the assets that we have in our universe in the cross section every quarter. Let me explain that again. If we agree that expected returns are equivalent to market discount rates, we can basically figure out what the discount rate should be if we can observe expected returns. Right? So we observe expected returns in deals in the secondary market each quarter. Over the past 20 years, we observe, and we've qualified in our data more than 1,000 of these deals. Now, each one of these deals, and it's implied expected return, we can break down statistically by risk factor just to explain them statistically. So you have to have the right statistical model. So we spent a lot of time on that, figuring out what were the drivers and what was the best statistical model that predicted out of sample best the risk premium of actual secondary market transactions. Okay, now we can do that because in each deal, we're saying, okay, well, these are different companies. This is an airport, this is a pipeline, etc. But basically, these are all equity transactions and infrastructure. They're all exposed to the same risk factors, only in different quantities. So maybe one of these projects is bigger, maybe one is more leveraged, maybe one is low profitability because it's still greenfield, and another one is high profitability because it's brownfield, etc. So they all have these characteristics. And so despite the fact that they're quite different infrastructure companies, because they have common risk factors, we can try and extract the price of these risk factors. So these exposure to risk factors, we're going to call them beta, so the size of the company, for example, or the profitability of the company. And the premia for each one of those factors, we're going to call lambda. You know? Now, I won't go into the details of the statistics, but once you've done that, once you have the lambdas, once you have the risk premia for each risk factor that you've extracted from over time, you've extracted from actual deals. So obviously over time, these things change, right? The price of certain risk factors changes over time. It's a market. Then for any company for which I know what the factors are, I know the betas. So I know you have the list of factors here at the bottom of the slide: the size, the leverage, the profitability. Investment is a sort of capex ratio, capex to total assets, term spread, and also some control variables for the various sectors. Once I know all of this and I know the price, the lambda, each of these factors, all I need to do for the next company that I need to price, okay, is multiply the two together, the betas by the lambdas, and I can build a risk premium at that point in time. So a market implied risk premium for each company that we try to value. All right, so let me show you how this works in practice as an illustration. So first, I'm going to show you the EV to EBITDA of a number of deals, not all of which, in fact, are inputs in our database. Some of them are not, so they're truly out of sample. And so this is you see on this picture on the right, each dot is the EV to EBITDA of a private infrastructure deal over a period of 10 years, ending at the end of 2019. And the blue line that you see in the middle is the average EV to EBITDA of all the companies that we price in the index, so in the universe. So that's hundreds of companies, like I said, and we price them each quarter. So if I put all of their prices on this chart, it would be a huge mess. You couldn't see anything because there'd be literally thousands of points. But here you can see the average, the blue line, okay, which is what we predict is the EV to EBITDA of all the companies that we track. And as you can see, obviously there's some kind of interesting relationship between the dots and the line, which is that the line is very close to, well, crosses the dot plot right in the middle. If you look at, so how spread out, so obviously, like I said, we're going to build a discount rate and a risk premium for each company at each point in time. So they will get a different risk premium. They will get a different price. So the EV to EBITDA, the blue line, is just the average. In fact, we have valuations for companies which are spread out. So 90% of the valuations that we produce are in that gray area. It's meant to be pink, but it's a bit gray. In the middle, that's the 90% confidence interval. And the blue area is the 97.5% confidence interval. That's basically 2 standard deviations from the mean. That's basically almost everything. So almost everything that we predict is in this zone, if you want, with this mean value over time. And as you can see, there's a very strong match with market data. Now, I just want to add one more point on this, which is the airports, because we talked a lot about airports. And as you know, we have, as you may have seen, we have very negative results for airports this year, which is something that has very drastic implications for some investors, which are very exposed to airports. So I just wanted to return to that, because if I do the same exercise, so I compare airport transactions over time. So here I have 45 transactions, okay? And I'm comparing them with the quarterly valuations of 31 airports, which are produced by us. So our mean EV to EBITDA is this blue line. Again, 90% of what we predict is in that gray area. Okay, here you have a case, an example. It's Luton that was sold in 2013. So as you can see, there's a very good match between actual market transactions and what the model predicts. It shouldn't be a huge surprise. After all, the market transactions are the inputs of the model. What's interesting is that with this risk factor approach, you can actually extract from deal prices what you might call the systematic drivers of the equity risk premium, the infrastructure equity risk premium. And then if you can use this to value other assets, then they should be priced properly. They should be priced adequately to the market. On the right-hand side, you see the same data, but presented differently. It's kind of presented as a density plot, right? So the EDHEC one is the purple one. The deal values, the actual market values, are the orange or pink one, whatever that color is. And you can see in the table that the mean and the median of these two distributions are extremely close, which is pretty obvious from the picture. They're not the same. And again, the model that we use predicts the average value of a company that is like that. So a company that has these factor exposures and has these future cash flows would be priced like that. Individual deals might well be different because buyers and sellers will decide to pay a bit more, or they'll do a great deal and then pay a bit less. That's of course part of what the investment process is about. But in terms of predicting on average how the market prices behave, this is what you get. Okay. So I think that's quite an interesting, also quite a convincing presentation of these results. And again, I insist on airports because basically, if you don't believe in the minus 35% return in airports, I think you should, because this model is really good at predicting airport prices. And at the moment, it's saying that, as Abhishek was saying, the implied risk premium has shot up and the valuations have gone down a lot. Which brings me to our poll. This is a good time to do this poll, which we do every time. So I'm going to start the poll, and I'm going to ask you to give me your answers for these two questions. So first, given what you've seen, or given what your own beliefs are, what do you think are the infrastructure equity expected returns for 2021? And we're talking about the entire asset class, okay? So not a sector in particular, all sectors combined. What are expected returns like? Meaning, what sort of, to keep it simple, what sort of IRR should one be expecting in a new deal, in a fresh deal done this year? Based on what you've seen, you may have different views. So I'll let you answer that question. And the second one, a bit of a hard question. How much value has been lost in the airport sector? So on the one hand, of course, airports are very long dated investments. They've lost a few quarters of revenues, but they haven't lost all their value for sure. Nevertheless, like we were trying to say, the current value of these assets is not just determined by their future cash flows, it's also determined by the price of risk. And the price of risk for airports has increased dramatically because pretty clearly the uncertainty has increased a lot about what these future cash flows will be, when they will arrive, etc., etc. So there's going to be a need to write down some airports. Maybe, in fact, I phrased this question both as past and present because I wondered if it wasn't possible for some to have already done this year. In fact, it's quite likely. And so I'm going to wait for you to keep taking the poll. I have 74, 78 answers. Come on, I want 100. So another 20 of you have to take the poll. Getting there. Okay, we have some clear winners as well, which is always nice. I will end this and share the results. Hopefully you can now see this. And you can see that the winners are in the expected return category 7 to 8%. And then a good third of you thinking more like 8 to 10. And in the airport, the write-down category, very clear winner was 30% write-off. So that's pretty much in line, in fact, with the results we've just shown you, minus 35% return. It's total return. But anyway, there were no dividends in 2020, so it's the same thing than the price return. Okay, so a few more words, and then we'll do the Q&A. Just to summarize, really, 2020 was a bad year, but it wasn't the worst year for every infrastructure investor. I think that's clear from both the comparison with the GFC, where more assets, in fact, were impacted, and because it was more of a risk pricing and also a leverage crisis. Here, the impact of COVID was much more heterogeneous, even though everybody was impacted by higher risk premia at one point, every sector. For a lot of investors who were, say, invested in contracted assets and project finance, they basically weathered the storm pretty well. Something that we keep repeating, so I'll repeat it again, the impact of COVID was, yes, to degrade cash flow, but it was also to increase the risk premium, and that's not something that must be remembered and repeated, because there's a lot of focus on cash flows, but the uncertainty of these cash flows is what determines their present value, and clearly, in some cases, this uncertainty has changed and it's increased. The price of this uncertainty also has changed, and projects were very resilient. We're going to come back to this in a minute because there's a question on that. Contracted infrastructure was more resilient. I also mentioned this. One thing that I'd like to highlight is that if you use the TICCS taxonomy, you can actually understand the stuff, because TICCS tells you in which buckets of business risk, or in which activity and industrial activity segment, or whether you're looking at projects or corporate, your investment kind of falls. So in terms of deciphering what's in your portfolio, or building a strategy, or defining a product, using a clear-cut taxonomy like this that's objectively defined, that's also supported by the industry and by quite a lot of investors to use it today, it means that you don't have to grapple with well, what is it that I'm actually investing in, because I'm not sure what core plus actually means. This allows you to actually have an objective understanding of your portfolio. Second, penultimate point that I would like to make was that if you use the approach that we're proposing, which is in fact pretty basic, finance, it's applying arbitrage pricing theory and multi-factor models. We see that actual transaction data can be used to calibrate a model of expected returns. So that's what we do. And the estimate a risk premium, which actually tracks the market pretty well. So again, going back to the philosophy of IFRS 13, the calibration of your model to the best and the latest market inputs, that's exactly what you're supposed to be doing to measure fair value. And so that's possible. And that's something that allows you then to understand the asset class much better and to measure risk, which has all sorts of other implications. Once you measure risk, you measure volatility. Once you measure volatility, you measure correlations. Once you measure correlations, you can do asset allocation, et cetera, et cetera. So the point of all this is not just to track the impact of COVID-19, because that's obviously extraordinary and very relevant, but it's actually to understand what are the drivers of fair value. And in conclusion, I would say that how bad this year was for infrastructure investors really depends on your benchmark in the end, if you have one. So I would put the investors in the category that have an absolute return benchmark in the category of not having a benchmark, because this year it doesn't really make sense. Well, it never really did, but this year it obviously doesn't. If you happen to want to have a benchmark, I encourage you to contact my colleagues as well. They can show you exactly what we have and how to use it. Okay, well, thank you everyone for your questions and for answering the poll. And we will close this now and wish you a wonderful day or evening.